So what's a cost segregation study? Why is it important? And how can it help save you tens of thousands of dollars on your tax returns? That is what we're going to be talking about here today. There's a lot of, not necessarily confusion, but a lot of people just don't know about what cost segregation studies are, how they're implemented, and what they actually do on the tax return. So we're going to be going through step by step what a cost segregation study is and why it's important. Before we even jump into that topic, it's very important to understand what depreciation is. When you buy an asset, that asset usually will deteriorate over time. A great example of this is like a vehicle. If you buy a car, as soon as you drive that car off the lot, it's common knowledge that that car goes down in value because it's been used, right? And over time, that car's value is going to continue to go down as it's used more and more. That is called depreciation. And so when we buy a rental property, whether it's commercial or residential or whatever it could be, that asset also goes through deterioration over time or depreciation. And we're actually allowed to take a portion of the cost of that asset every single year as an expense to offset the income generated from that asset as what's called depreciation. Okay, so that's what we're going to be talking about here today. I want to jump in. I'm going to do a whiteboard here. I'm going to go a new one. And what we're going to be going through on this whiteboard, they just changed all this on me, so I'm trying to figure out, make sure I'm looking at this right. What we're going to be going through on this whiteboard, I'm going to draw out an example of what a cost segregation study does. Okay, and again, it's all related to depreciation. So when we talk about losses on a rental property and stuff like that, we're not talking about cash flow losses. You never want to buy a rental property or to make an investment that you know is going to lose money. That's just not wise financial sense. But what you do want to do is you want to buy an asset that you are able to depreciate in certain ways, because that depreciation is not a cash loss, it's a tax loss, which is great for tax purposes. Okay, so what a cost segregation study is we're going to start from one end of it. We're going to talk about how a traditional accountant or traditional CPA would depreciate an asset like a rental property. Okay, so we have a little house here. It's a horrible drawing. I'm an accountant, I'm not an artist. And now what most CPAs will do is they'll take this house and they'll take the value of the house and they'll times it by 85%. So let's say we have a purchase price on this house equal to $350,000. Okay, so you bought the house for. Now that house is comprised of two things. It's comprised of the actual building, but it's also comprised of the land that that building sits on, right? The lot that that building is sitting on. That lot is not depreciable, right? Land does not deteriorate over time. Certain land might, but in this case, it does not deteriorate over time. And so we have to separate out the land value from the purchase price. And we're just going to say, to keep this simple, we're going to say it's $50,000. Okay. And so what we have now is we have a depreciable basis. What we can take for depreciation is $300,000. That's how much we're actually able to depreciate over the life of this asset. Now, what most accountants and what most people will do is they'll take that $300,000 and they'll take it on a residential rental property, which a useful life for a residential rental property is 27 and a half years. So they'll take that 300,000, they'll divide it by 27 and a half, which equals roughly about $11,000 a year, an expense that you can take. So what that does from your depreciation standpoint is you get $11,000 every year for the next 27 and a half years. 11K. Now that's great. There's nothing wrong with that. Well, there's a handful of things that can go wrong with that. But if you're the type of investor that buys an asset or a rental property like this, and you buy it once every 2 or 3 years, this is a great method for you. The reason it's great is because that $11,000 depreciation deduction will usually offset that taxable income for that rental property. And so the $11,000 will do the job for a lot of investors. Now, if you're the type of investor who this is your retirement plan, you're buying 2 or 3 properties a year, you're buying one big property a year, this isn't going to work out great for you. The reason it's not going to work out great for you is because you're going to have less cash available to you because you're paying too much in taxes up front. Okay. And so when you qualify as what's called a real estate professional, and you're actually involved in these types of activities and rental properties or other real estate specific activities, you're actually able to take the deductions and losses generated from depreciation from an asset like this, then offset your W-2 income, which decreases your taxes. It allows you to invest even more. Okay. And so if we were to do a cost segregation study on this property, what we would do is, instead of just having this breaking out land and then depreciating to $300,000 over the 27.5-year property, what we actually do is we take this $300,000 and we break it up into 3 components. Okay, those 3 components are: first, structural, which is structure is your 27.5-year property. Okay, but of our building, that building is not completely made of structural components. There's landscaping, there's carpet, there's light fixtures, there's appliances included in that building, right? So we have land improvements that are separate. Land improvements are not the land itself. Land improvements are the landscaping that goes on top of the land. This is 15-year property. Okay, and we also have contents, right? The contents are 5-year property. Now the contents are your carpet, your appliances, those types of things. And so what this does to our cost, to our depreciation schedule, instead of just being straight line, now we take a lot in the first 5 years, then a little bit less in the next 15, between years 5 and 20, and then between years 20 and beyond, we take a little bit less, obviously, right? And so we have now a step ladder, basically, or a stair step down for how much depreciation we're going to be getting throughout the life of this property. And so what you do notice is that the depreciation expense overall does not change, right? Throughout the life of the asset, or over 27.5 years, we're still taking $300,000 as an expense. What we do with the cost segregation study is we front load a lot of that depreciation, and we reduce how much we're taking in the tail end of that 27.5 years, which, if you're a heavy investor, is more beneficial to you, because instead of getting $11,000 of deduction in the first year that we would get here, you're actually looking at getting probably roughly like 25-ish thousand for the first 5 years. And then it drops down to probably about 14,000, and then it'll drop down to probably about 3,000. And so it's more beneficial. But where the big kicker comes with the cost segregation study is, now that you've reduced this to 15 years and we reduced this to 5 years, our 15-year assets and our 5-year assets actually qualify for what's called bonus depreciation, which is an accelerated method of depreciation. What that does is it allows us to fully deduct our land improvements and fully deduct our contents in the first year that we buy and place that property in service. And so usually the land improvements and the contents in a typical residential property will make up about 30% of the cost. Okay. And so with this property, what we can basically assume is that we can get roughly about $80,000 to $100,000 of deductions in that first year, and then we drop down to whatever's left over. So we'd be able to deduct about $100,000 from this property in that first year, and then it would drop down to probably about $3,000 every year after that. And so if you are doing this on a regular basis and you buy 2 properties in a year, and they're about $350,000, you should be able to get roughly about $200,000 of deductions to offset your ordinary income. Now, the big change that has come into play within 2023 is that bonus depreciation has actually dropped from 100% down to 80%. And so we wouldn't really actually be able to take this full 100, we'd be able to take about $80,000, which is still extremely beneficial. So it's really important to make sure that before you jump in and start cost segregating all of your properties, that you meet the qualifications in order to actually take those deductions against your ordinary income. A lot of the times you can't, right? There are a lot of rules, and jump on my social media pages and jump on any of my other sites to get an idea of what the rules are around being a real estate professional and how you can actually take these deductions against your ordinary income. Because while these are very powerful, there are a lot of rules that we need to make sure that we go through in order to execute this strategy properly. Okay. My name is Stephen Gabrielson. I've been a CPA for about 7 years. I've specialized in real estate for about 5 of those years. And so we are very good at dealing with real estate properties. About 95% of our clientele is involved in real estate in one way or another, and we execute these strategies with them on a daily basis, helping our clients save millions of dollars every single year on taxes. So these strategies are extremely powerful. Do not hesitate. Click the link down below to schedule a call with either myself or one of my colleagues, where we can walk you through these strategies and how they apply to you specifically, and how we can really help reduce or even eliminate your tax liability. It's not uncommon to see someone who makes $1 million a year through their business not pay anything in taxes if they invest it smartly and in the correct way. Okay. Thanks for watching. Please subscribe, follow along for more, and until next time.